Hey business owners and real estate investors, you've probably heard a lot about the One Big Beautiful Bill, or the OBB bill for short. It was just enacted on the 4th of July. There's been a lot of hype, so many opinions and things to sort through, but today we're cutting through all of that and focusing on one key aspect that we have used to help our clients minimize their tax liability. Now, we're not here to get political, but rather want to help business owners like yourselves maximize tax savings, providing additional capital to reinvest in their own growth. The OBB bill just brought back one of our favorite vehicles for doing just that and made it permanent, the 100% bonus depreciation. Now, this strategy gets a lot of media attention, but is often misunderstood and incorrectly applied. When you do get it right, however, it can create large tax shields and supercharge real estate returns. But you need to clear some IRS hurdles first. Our goal today, to give you some clarity on the key rules and show how the numbers work in practice. Now let's dive in. Here's what changed on the 4th of July, 2025 due to the OBB bill. Among other changes, and there were several, bonus depreciation became 100% again, and additionally was made permanent. There are no phase outs. That means every time you buy a qualifying property, here's some examples: personal property, equipment, software, and even portions of vehicles, you can now deduct the entire cost in year one. No phase outs, no sunset clauses, no games. This is a powerful and massive win if you know how to use it. All right, we're going to run through a simple scenario. We're going to use real estate, and we're going to show you how to apply this 100% bonus depreciation. There are all sorts of assets we can use. We can use equipment, other types of personal property, but real estate is what we'll use here. Let's say you buy $1 million worth of property, right? We're going to use $1 million because it's easy. We can apply all sorts of math to it. Now, this could just be one property for $1 million or multiple properties that add up to $1 million. Either will work. Okay, we're going to take, typically on an investment property, you're going to put 20% down. So we're going to put 20% here. So that's $200,000. That's what you're going to put down as your down payment. Okay, and then what you're going to do is run a cost segregation study on this asset, on this real estate asset. Typically, we can pull out about 30% in a cost segregation. So our deduction here that we can do with 100% bonus depreciation is $300,000. Okay, so I'm going to put parentheses because that means this is our tax shield or our paper loss right here. Okay, now a lot of people earn, not a lot of people, but when you earn active income, it's typically in the form of a W-2. And let's just say, for example purposes, you have a salary of around $300,000. Okay, so what we're able to do, so this is your W-2 or other salary, other active income salary. Okay, so this is positive, this is negative because of your paper shield on here. That means your taxable income is $0 as a result of this strategy. All right, so essentially what you would pay on this if you did not implement this strategy is around $75,000 in federal or IRS and state taxes, depending on what state you live in. Obviously, if you're living in California or New York, it's going to be quite a bit higher, and we have, those states that have zero income tax, so it would be a little bit less. But when you have $75,000 in savings that you wouldn't be paying as a result of this strategy, your down payment really comes down closer, right? We're going to apply this here to the savings. Your down payment is around $125,000 to control $1 million in real estate assets using this strategy. So this really becomes more of a 12.5% down payment. You're saving $75,000 in taxes. You're controlling $1 million and getting a $300,000 tax deduction using this new strategy now available to us as a result of the One Big Beautiful Bill Act. All right, the catch is the deduction will not affect your active income unless you meet certain qualifications, qualifying as a real estate professional or meeting the short-term rental exception. We'll talk more about these, but essentially making yourself a business owner. Fail to accurately track or meet the hour requirements, and your cost seg losses will reduce or will stay passive and only reduce your passive income, not your W-2 or other active income. Now, if you're not a real estate professional, there's a powerful workaround, the short-term rental exception. We'll talk about that here in a second. Here's what you need to do to qualify for that. Your guests need to stay an average of 7 days or less in your real estate investment. You personally, involved in the business, need to work around 100 hours per year, or at least 100 hours per year on the property. No one else can work more hours on it than you do. These are actually hurdles that are pretty reasonable in overcoming if you're getting involved in this type of investment anyways. If you meet those three, your losses are considered non-passive, even if you have a W-2 job. So here's your playbook on what to do next. Start tracking your hours. Use a spreadsheet or some sort of a time tracking app. Make sure you're documenting your activity, all the calls, the visits, the guest communication, cleaning coordination. Make sure you put the dates on those activities. By doing that, you really protect yourself around an audit and what you need to do there. Next, you need to hire a real cost seg firm, not just someone with a landing page. Talk to your tax strategist early and make sure they understand real estate professional or short-term rental rules. This is important. You don't want to be left covering the bill because you don't qualify. This is an important part to the strategy. This is where most people trip up. Don't leave a six-figure deduction on the table. So let's wrap up and build wealth with paper losses. This is what we're trying to really help you guys understand. Cost segregation with the OBB bill plus short-term rentals is a very powerful tax strategy play that opens the doors to other plays. You're not just buying real estate, you're buying leverage, reinvestment, and long-term wealth. Now, if you want help structuring the deals, qualifying properly, or just even running the numbers to see the power of that return and the impact that it has on your return, book a session with our team. We'll help you stop guessing and start seeing clearly. Let's do this.